If you've only just tuned in, feel free to check out last week's show, where we covered off on some historical examples of high inflation and then assess whether the key inputs of inflation in the past apply going forward. The answer is no, probably not. We also looked at the impact of emerging economies, in particular China, on commodity prices and its subsequent impacts on inflation. As the behemoth in demand of global commodities, it makes a lot of sense to consider China's fortunes going forward when forecasting inflation. Well worth a look if you haven't already. In today's show, we aim to cover off on what could be a pig in the python of global inventories. This has come about as companies scrambling to fill gaps in their supply lines created by the pandemic have overbought inventories to fulfill unmet demand. They have also lifted stock levels to guarantee their orders are a higher priority and ensure that they are adequately supplied in the event of another disruption. Next week, we'll then finish off, of course, with ways that portfolios can be prepared to protect both from short-term inflation and hits and also maximising the upside of growth markets. Joining us today, of course, to share his views is our Chief Strategist, David Llewellyn-Smith. Hello to you, David.
G'day, Tim.
And also here to share his thoughts on our take on the emerging inflation risks and how we reflect these in our portfolios. We have Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
And just a quick reminder, before we get started, if you haven't already, subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you could take a moment to click like on the video now to help our show grow. And for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. All right, so we'll get into it, gentlemen. So we've got our agenda for today. So we're going to kick off with PMIs. What's a PMI, Damien, just for those listening in?
Yeah, I know. I shouldn't be using acronyms, should I? Purchasing Manager Index. Yeah, I know. It's a Purchasing Manager Index. And so these are surveys that are basically trying to get a view on what's happening at the moment. And but we'll run into those once we jump in.
Sure thing. Okay, so there we go. We'll then be looking at typical inventory cycles. They'll then be running across into today's or current inventories and sales, rolling into retail sales, and then finally having a look at capacity expansion as well. So a big focus on the inventories today. I'm really looking forward to it, and the impacts obviously on how that can translate into inflation, mate.
Yeah, it's a very exciting topic, the whole inventories, isn't it?
Just for those listening in, Dave nearly pulled the pin, but we enticed him back because it's going to be a good chat today. But it's good. He's a little bit under the weather, so we do thank him for coming along.
Yeah. Pleasure. Just forgive my voice. I've got a bit of a cold. So.
No problems. All right, very good. So PMIs, Damien, booming.
Yeah. So maybe we can bring up some charts. So the purchasing manager indexes. So what they are is they basically are asked. It's a survey of people involved in various industries, and they get asked, what's happening next month? Are sales going up, or are prices going up, or how are you finding? Are you planning on hiring people? Like, there's a whole bunch of these survey type things, and they're all generally measured as a 1 month. Are things better than last month or worse than last month? So they're not. The issue with it is it doesn't give you the context. So if you've had a really bad, so let's say in the so coronavirus hits, and there's this massive fall in terms of people's sales. If sales falls from 100 back to 50, and then the next month it goes from 50 to 55, the PMIs are actually really positive for that, because they don't care that you're 2 months ago, you're still down 45% on where you were 2 months ago. They just care that where are you versus the prior month. So that's the first thing to just keep in context, is that they're not it's not a it's not a one. It's not an overall factor. It's just a 1 month measure on it, and so and they're booming. So Dave, do you want to jump in? Maybe you spend all day talking about these type of stuff or writing about them.
The PMIs.
Yeah.
Yeah, well, I mean, they're sort of useful look when you're looking for changes in second derivative. So you're looking for rate of changes. You know, whether a rising trend is slowing or a falling trend is slowing, so that they're useful in terms of picking turning points. But you got to be a little bit careful with them because they are directional rather than positional. So it's not much good looking at a PMI if you're after a year-on-year read for anything. It's really just about how we're going this month versus the last. But there's no doubt that right now reads across the world, across the industrial world, and when I say that, I mean almost everywhere is flat chat in the PMIs. Like you get a huge wave of these things come out at the end of each month, summarising the month prior, and they've got some leading indicators in them as well, like new orders. And we've just been through a wave yesterday and the day before, and just crazy highs everywhere. So all the industrial capacity in Europe, the US, across Japan, Taiwan, they're all just at record highs. Korea has come off for a couple of months. Southeast Asia was a little bit lagging because it's got COVID shutdowns, but they were all still experiencing record high new export orders. So their external environment was still really strong. China's PMIs have come off a bit already, but they're still showing growth from what is a huge rebound from last year's slump. So the read basically at this point, I look, as said, I look at these things looking for hints about turning points. And the latest batch suggested that, you know, we're still going like the clappers, even though there may be a few early warnings in like Korea, PMI, for instance, which is very export driven, and stuff, which has been falling for a little while. And perhaps China a little bit too. We know there's a slowdown coming there. But it looks like aggregate demand in the global economy, especially in the industrial economy, which is servicing all of this huge demand for goods that's come out of the pandemic, with stimulus checks posted out everywhere and no one able to spend on services. It's still going strong. So, you know, at this stage, you know, I'm expecting it to sort of roll over soon, because, you know, some of the stimulus starts to wind down, plus catch-up growth, as we discussed previously in these chats, which is the phenomenon of, you know, growth that was paused during the pandemic and then resumed, whether that be a building project or, you know, someone else's IT project or whatever. They all resume, and so they resume alongside new activity, and so you get this big, like pig in the python, as Damien called it, of activity for a little while as you come out of it. And for the time being, the pig is we're still in the middle of the pig as it passes through the python. But what we're expecting is that it will pass through, and so those PMIs before too long will start to roll over and show the improvement in conditions slowing down dramatically.
Absolutely. So, so that first one, we're looking new orders. The next slide, we've got, you know, just showing the backlog of orders is really high. You can see their customer inventories are particularly low, so even lower than they sort of hit in the recovery in 2008. So all these signs, and then the next one, we're just looking at some prices and out of stock things. So they'd be all telling us the same story, that what we're looking at is a real inventory shortage out there. And so I guess what I wanted to run through is sort of what a typical inventory cycle looks like, because you know, the maths behind it was very simple maths, but it's surprisingly it's surprising how great the effect is on people who are downstream. And so I've got a table up there just sort of showing this steady state, where you have retailers, you have wholesalers, and you have manufacturers. And basically the idea is the retailer is selling like 100 units every period, whatever it is, month or week or whatever it is. And then they have this inventory of goods, which, I've called the inventory to sales ratio. I've called it in this case 1.5. So basically, if they're going to sell 100 a month, they want to have 150 in stock because, they might have a big month and they want to be able to cater for that extra demand. And so usually there's a, or if this is a weekly or whatever it is, but the idea is that you want to own a bit more inventory in your stock than what you're selling because you got that issue of making sure that you can have a big sales week without, or big sales month without sort of running out of things. So that just sort of flows through. The next chart is the more interesting one where we say, okay, well let's say actually I've skipped the chart here. Sorry. Yeah, no, they've got it right. So we've got these three new periods now, period 4, 5, and 6, and in the first period, what we've had is the retailers dropped to 90, so 10% less sales for the retailer, and you can see that means that they now end up, because they had 150 of inventory the prior one, and now they've fallen to 90, and they're only expecting 90 sort of going forward because of a coronavirus or whatever, is now they've got 160 sitting in their inventory. And they actually only want 135 because they want 1.5 times. So what that means is they're no longer going to place an order to their wholesaler for 100. They only want to place an order for 90, but they've already got all this extra inventory. So they actually only need to place an order for 65 to get their inventory back to 135, and then after that they'll start ordering the 90 again. And then the wholesaler does exactly that same thing with the manufacturer. And because of this lagged effect, is that the manufacturer actually only gets an order for 40. So you can see in terms of the retailer, so basically bullwhips your way down the end. So the retailers only had a 10% fall in sale, but the wholesalers actually had a 35% drop for that next period, and the manufacturers had a 60% drop. So because there's all this inventory that sort of gets pushed through the system, and so it's and this is what sort of helps cause a typical cycle, because this happens, that the whole the manufacturers really suffer, the wholesalers really suffer. They go out and sort of start either firing people or pulling in, and or trying to save money, and then that affects other companies in it. And then you can sort of come out the other end, which is onto the next one. And I've only just put in here just normalizing, so going back to 100. And when that happens, the whole thing goes back into reverse. So I guess jumping right to the bottom, you can sort of see that the retailer's now up 11% to go from 90 back up to 100. The wholesalers actually jumped almost 40% in that first month before falling back again, and the manufacturers jumped almost 70% in terms of their growth in terms of the sales. And that's what we're saying is going on at the moment, is that you've got this inventory restocking cycle where not only do you have these stimulus checks bouncing around, and there's sort of 3 or 4 different effects, which we'll move on into in a minute. But you've got the stimulus checks, which is increasing sales. You've got the fact that people can't buy as much services as they probably would want to buy. Things like travel you just can't do, and a lot of recreation and all these other things that are sort of being shut down in various countries. And plus there's the re-spend of, okay, people didn't spend for a little while in the lockdowns, and now they're out spending a bit more money as they're coming out of lockdowns. Plus the inventory cycle on top, you sort of added a whole bunch of factors all to this one, the typical cycle. So you've actually sort of extra juiced the cycle, so to speak. And we can see that
Damien,
if we look.
so you're saying we're in period 10 at the moment, is it, or period what?
Yeah, where are we now?
Or is that looking slightly forward?
We're coming through period 8.
8, yeah, okay. Yep.
Yeah, and actually, having said that though, like this is probably I've just put a typical cycle. I would say the period 7, it probably hasn't jumped to 100. It's probably jumped to 120 or something like that. But then it will fall back to even harder. It'll fall back to 100 eventually. But there's actually an even bigger push than what I've shown to this one. Like this is just this is a typical sales falls by 10%. How does everyone get affected? Sales goes back to what it was. But I think we're in a special case for where we are now for ourselves.
Sure. Yep.
That being said, add that as boring as this appears, this is actually the basic mechanism of every recession. Like, this is what drives a recession. I mean, there are obviously different triggers, and there are balance sheet issues and stuff that create these circumstances for a recession. But the actual crash in growth that you get for a recession is largely driven by this cycle. So if you go back to where we started, where you get a knock, say from sales from 100 to 90, which is from some sort of shock, typically that's going to be a financial market freeze or an asset market crash, whatever it happens to be. And then you
Pandemic.
get in this case, a pandemic. Then you'll get those cascading impacts that go through the industrial system, and you're suddenly minus 60% demand. And then once that sort of passes and a bit of stimulus is thrown in, and the end user comes back in and buys, and you either pop back up to the 100 or go a little over the top, then suddenly you get this huge cascade of extra demand, and the whole industrial system tears out of the recession. And so you always get this huge pop coming out of a recession. This is very, very, very typical. It's just, as Damo says, this one is very exaggerated. The dip was so deep, and there are very particular sort of demand distortions that go with the pandemic.
And the other thing is worth saying, like I've called it periods in each of these, because for some industries this might be quarters. For other industries, it's months. For other ones, it's days.
Yeah. I was going to say, because you've got so many different forms of supply chain, haven't you? You've got things that can be trucked from one town to the next, and then others that need to come across by ship for certain months overseas. So.
Yeah, absolutely. So everything, different industries will be affected at different times by that as well. So for some industries, they're probably already at period 10, and they're back into the normal circumstances. Whereas I think most of them are sort of somewhere between 7 and 9.
Okay.
Yeah. Okay. So if we look at this, then at the next chart, what I've got here is just for the US market, just the total inventory to sales. So and we can see that that's really slumped. So the number of so the amount of inventory that people have compared to the sales is now down to sort of 1 point, or close to 1.2, and certainly lower than it's been any time over the last sort of 30 odd years. So it's really showing that inventories have really fallen. You're in this stage where you do need to have the restocking. I've got a chart there that breaks it out into the different areas, so you can see the retailers versus wholesalers versus manufacturers. And actually, I must note though as well, this is only the March data, so everything sort of is a bit mixed up. So we do have some April data for some things, but not the full set yet. And so, and you can see it's mainly affecting the retail side of this. Has been the real part that's hit. So there is probably still a bit more to come through that. So that was at the end of March, and so now we're really seeing we've had April, and we're done with May as well. So and that's where we're really starting to feel the manufacturers. So I expect you'll see that line over the next 2 months will really dip down as you actually see what's going on, because what we're feeling today from the PMIs, the purchasing manager indexes and other things is actually a right now versus this stuff which is really looking in the rear vision mirror.
Okay.
Yeah. So then if I jump into actually breaking it down to what's going on, the next is just a table of the two parts to it, the inventories and the sales. And so you can see that the sales has really picked up for the retail side. So that sort of cruised along the whole time. You had the wholesaler manufacturer, exactly that inventory cycle we spoke about. The wholesaler sort of moved a little bit earlier than the retailer, and then the manufacturing sort of followed behind that. So that the wholesaler sort of started turning green a little bit earlier. And you can see now that the wholesalers, as at March, the wholesalers, retail was running at 12% growth. The wholesalers had picked up to 6%, whereas manufacturing was still, waiting, they're sort of lagging behind at that point. And what we fully expect is you'll see that this will flow through. The retail will peak, then the wholesale will peak a month or two afterwards, and then the manufacturing will peak a month or two after that. So just a very typical inventory cycle. And you can see that about 2/3 of that decline we spoke about before is really coming from very strong sales, and then the other part's coming from weak inventories, which is important because if you think that that most of the retail spend is people who have been given stimulus checks and can't spend it on services, and so they're spending it on goods instead, is that the more that comes from higher sales, and if people are sort of leaving their inventories going, you know what, I'm not going to let my inventories, I'm not going to build up these massive inventories expecting this to keep on going, then the effect won't be as much when you come out the other side. But the problems come where once people start thinking, hey, this is a new normal, actually I do need to keep these massive amounts of inventories, that's where you can, the shock on the other side is much worse. So there is a little bit of preliminary data for retail sales for the, I've got that on the next chart for some categories. They're not all sort of out at the moment, and apologies for how small this is, but I'll post something up later on today that sort of has this in a bit more detail. But I guess the key message from this next chart is, or the next table, sorry, is that things are booming. And they keep booming into, so far they keep booming into April. So these are different measures, but we're certainly seeing retail and food services is sort of up 10%. Was up 10% in March and up again another 10% in April. You look through all the categories, clothing's a bit weak, but besides that, everything else is just running at these incredible levels that just way above prior levels. And I've done these as a 2-year annualized growth. So the other problem is if you look back 1 year, that looks even better. Like you just get these massive figures that to be frank, are a little bit meaningless because a year ago the US was all in lockdown, and everyone was still getting used to how lockdowns worked and things weren't working and people weren't going to, businesses weren't set up to be run with remote and all those types of things. So the 2-year gives you a much better feel, but you can see that, just across the board, things like sporting goods and stuff like that up almost 20% on a 2-year annualized basis, and basically anything to do with cars and car parts and all that type of stuff up close to 20%. Annual, on a 2-year annualized basis as well. So certainly the retail side is going very, very, very strong.
Just a question on that. So obviously we're looking at a fairly broad macro piece. Is there an opportunity to test the narrative on, say, a country that's a fair bit further ahead in terms of recovering from COVID? So, obviously we've had stimulus and then things have gone back to normal. An easy one always jumps out is New Zealand. It always seems to be doing quite well and, being at the head of the pack in terms of that. Small economy, granted, and a lot of exports, but is there an opportunity to test the theory on
some of those? Yeah. Look, the problem though as well, even in New Zealand though, is you've still got the problem is that people can't travel much, and it's not the same type of travel, so they're still a little bit limited in terms of what they're spending. But you do see the narrative follows. I haven't checked New Zealand in detail, actually, I must admit, but I've looked at Australia, Japan, Europe, and sort of they're all at different stages of it. But the narrative sort of adds up as you look through different countries. Yeah.
I think I'd probably look at China as the leading case. First in, first out, first to stimulate, first to corral the virus. And been growing through those various factors the longest. That said, their stimulus is very differently structured than the Western stimulus. Like they go much more supply side than they do demand. And
the other thing is they're benefiting from all this, a lot of this stuff. So lots of big lift, 20% lift in car parts in the US means that the supplies in China are actually running at full tilt.
Absolutely. The experience of China is that the consumer, as I say, they did stimulate consumption to an extent, and certainly tried to stimulate house prices a little bit, and so some of those classic asset price spillovers for households, etc. But the consumption rebound in China was was okay, understimulated versus others, and has come off pretty quick.
Right. Yep.
So, you know, the nature of the developed economy as a stimulus is about to change a lot. It's been all demand side till now, and it's about to go all supply side. Like, I'm not talking about next month, but over the next 12 months. So, you know, we've had 2 or 3 huge waves of household targeted stimulus in the US, I think to the tune of 9 trillion. Is it, Damo? It's 7 to 9 trillion. It's some fantastic. Yeah, it's an enormous number, which has delivered the chart we've got here on personal consumption expenditures, like just a V-shaped recovery out of what was, you know, an almost ruined economy. And we've got another 4 trillion planned, but that's not going to come through until sort of late next year. That's the Biden stimulus. And the reason there'll be a lag is because it's supply side, it's infrastructure, it's human infrastructure, you know, it's education, it's health, it's all sorts of stuff. But nearly all supply side directed. So, you know, focused on productivity gains and etc. So it's not shovel ready, as it were. It's very easy to throw a check at households and get a bang for your buck, but it takes more time to do supply side stuff. Quality supply side doesn't take China long because they just throw a check at a property developer who throws up another apartment block. But if you're going to do it properly, it takes time. So there is a lag as the US, this huge demand side stimulus rolls off year on year. So we had big stimulus checks come out in the second half of last year, and then early this year. And so once we get to sort of pushing through Q3 and Q4 this year, that will automatically roll out of the numbers. And so you'll have just an absolute fiscal cliff of stimulus. And that then has a bit of an air pocket before we get to the Biden stuff later in 2022. So in terms of how that's going to hit this inventory cycle and looking at China, I guess, as the leading indicator, I mean, there is an air pocket there for consumption, I think.
Yeah.
Like that.
Well,
it's not all doom and gloom, because as that stuff rolls off, the private sector reopens and you get that different activity. But it is an enormous amount of money that was spent in the economy last year that won't be spent this year. And so ipso facto, that's just a big blow to potential growth.
Yep.
So this goods versus services chart that we had up there, if we can just put that back up again. So what that's basically showing is, so US personal consumption expenditures, which is the expenditure on both goods and services, it's sort of come back to that line it was on before. It's been through that big dip. And then you can see on the chart on the right, though, shows in the latest month where most of the spending's been. And you can see that the ones that are dominating the top part is the services. And that's what we were talking about, is this whole switch and the handover from durable goods and all those other factors now on a relative basis falling back. And as people can spend on travel and recreation and things like that, they are starting to spend on that. And so that's that same part we're talking about, where we're saying, okay, well, if we are in an inventory cycle and people are spending money on manufactured goods because that's all they can spend it on, and then that's changing, that's just one more reason to say, well, the growth we've seen and this boom we're seeing at the moment is not sustainable and will come to a finish.
The tide's got to go out again.
Yeah.
So then you go, okay, well, what are manufacturers doing? So they're obviously having these massive increases in demand, and the danger is that the manufacturer gets this, what it was, 70% increase in the in orders. They rush out and increase their capacity, and they go around and create all this extra supply to be able to service the demand they can see at the moment. And then just as that demand rolls off, they turn out and go, oh, okay, now we can handle 50% more supply, and the person at the other end goes, well, I don't want 50% more supply. I just wanted that to fill my inventory. Now I'm good. Now you're about to fall back in terms of your fall back to a normal level. And so, and then you get all, if too many suppliers have done that, then they start competing with each other, saying, well, I've just built all this extra supply, I want to get some money for it. So what if I cut my prices? Will I be able to sell more? And if everyone's doing the same thing, then you actually end up with the deflationary end of this. So you can see, this capacity expansion. This is an OECD one. Is that equipment and software in particular has just skyrocketed in terms of the spending on that. We can see capital goods. If you get rid of defence and you get rid of aircraft, they could be very lumpy. But you can see, that whole capital goods has spiked considerably higher. So it does very much look as if companies are out there spending, to increase capacity.
And just add to that as well, Damien. Obviously, from the stimulus point of view, and obviously probably talking more about Australia that I know has happened, but not I'm sure it's happened around the world, is that companies have been given significant impetus and stimulus to do exactly that, haven't they? Through tax write-offs or bring forwards and all the bits and pieces that they can do to sort of get out there and expand their factories into this new demand.
Yeah, absolutely. I think Australia, to me, is one of the is more extreme on this end than a lot of other countries. They've certainly targeted capex in Australia considerably more than particularly the US but also Europe. But there still is definitely in those countries. There's still a fair bit of support for this capital expenditure.
I think in Australia's case, an elegant way of describing it is probably that we're about to enter an era of historically cheap toilet paper for many years. Because as we know, every time we go through one of these lockdowns, toilet paper demand goes through the roof. And so there's been all sorts of fantastic capacity expansions in the of toilet paper. Now, the moment the nation is vaccinated, we're going to be flooded with cheap toilet paper.
Wallpapering our houses in toilet paper rather than money.
Yes.
Yeah.
Very good. All right, cool.
So that sort of leads to this capacity expansion part. So and sort of I guess finishes off really is basically saying, well, it does look awfully like we're going through an inventory cycle, and even if it was just a typical inventory cycle, we'd expect to see this massive increase in sales. But then we've also added to that stimulus checks within the US, and some to a certain extent other countries, but very much in the US. We've got the reopening as people are some pent up demand as things they haven't done, and they're getting back out and doing things. And spending more money now as they're sort of feeling a bit safer and other things with vaccinations. And then we've got the whole goods versus services where people have been spending more on goods because they haven't been able to spend on services. And that sort of leaves us this massive sort of pig sort of pushing that way through its python. And sorry, then to cap it off, we've got companies out there spending money to increase their capacity. And so when it rolls off, and the question is this a couple of months, or is this a 6-month period, or is this a 12-month period? There's and it'll change between industries. But the question is, as it rolls off, chances are we're actually looking at this creating being a deflationary push. So at the moment it's inflationary because everyone's rushing around trying to the supply chains are empty. They're trying to bid up prices of things, but some of the types of things that were short, particularly say the car industry, is very short of chips. And the chips they're short of, though, aren't their high-end chips. It's the very cheap chips, so the ones that sort of, doing the car mirrors or the doors or whatever it is. These very, very cheap chips that have been around for a long period of time that the chip makers aren't making because they make very small margins on them. They make much larger margins on these other ones. And net effect to the overall cost of the car isn't very much, and once they but there will be extra capacity in it. There's certainly people who are willing to produce that. It's just that if you only have one factory, then you're not willing to produce sort of in the quantity that they want them at the moment. So
there's a staggering amount of money going into semiconductors. It's staggering. So you go out a year or two, there's going to be a huge glut.
Yes.
And a lot of it I mean, we don't, I guess, want to get too far into this, but some of these strategic sectors, they're being politicised as well, because the pandemic has kind of revitalised consideration of sovereignty. And so you have various political incentives to build out capacity as well, beyond what the market will need. So that will also be deflationary in due course.
Yeah, and you'll probably find, I expect there'll be a little bit of a, I don't know what, the 2 or 3 year cycle that's sort of a little bit embedded into the industry a bit more now than what it used to be, in that we just went through a year where all of a sudden a huge proportion of the developed world's population needed to go to working from home, and there was a big spend on, we saw video cameras and laptops and microphones and all these types of things that were in this real shortage as people all bought them. They won't need to buy a new laptop for a few more years, Yeah. So, but then there'll probably be another push, say in 3 years' time, as all the laptops from last year are running out, that everyone needs to start going and buying new equipment. But there is that, there's certainly that element of a lot of money was spent over the last year on equipment like laptops that probably won't be spent in future years. Sorry, it will be respent again, but there'll be a bit of a lull in terms of everyone's just got one, so they can last a couple of years before they need the upgrade.
Okay. I'll throw out, of course, to anyone listening in as well, to feel free to pop in some questions into the YouTube live stream chat. I've got a question. I want it to sort of maybe serve as a bit of a precursor for what's coming up next week in our sort of capstone into how we can turn these into the portfolio sort of solutions and whatnot. But so when we're looking, so obviously we're looking at the manufacturing side here, and that's this demand sort of driven inflation piece. It has, I guess, as we mentioned before, there's sort of short, medium, and long term manufacturing cycles and supply chains and everything else at play. Is that going to ease perhaps the potential for a shock in inflation? So obviously we're seeing at the moment things are tight, orders are high, but then will shorter what's the word I'm looking for? So the shorter supply line Fed thing be able to actually ease some of that shock, the potential for inflation demand shock over time, or do you think it's sort of it's something that's just going to sort of hit like a wall?
I think, different industries, there's slightly, because different industries are on different time frames. But my view is very much that it's coming like a wall, because it's been so globally synchronized that we all sort of locked down pretty much at the same time. And there's a little bit of sway in the vaccination side, but certainly most Northern Hemisphere countries sort of seem to be following relatively similar patterns in terms of how they're coming out. And although the US certainly had a big head start, the vaccine rollout in Europe really is going ahead quite strongly at the moment. And so I think you'll find it's pretty compressed. It'll be a very compressed cycle, and so a lot of it will all happen at the same time, in my view, relative to other ones. Other cycles where you might have seen an economic crash in one country and then slowly working its way through to other countries. Dave?
Yeah, I agree. That's why we're calling it the pig and the python, which, we don't want to labour the metaphor, but it's literally the case of a python swallowing a large meal and the lump passes down its digestive tract. And, the trick is, as it passes through, does the snake snap back to its former diameter, or does it get stretched and then there's no pig anymore? If you know what I mean. And so the whole snake ends up just falling flat because it's a bigger snake and the pig's gone. There's nothing to eat.
I think you might have stretched that. I don't know what you're saying.
Yeah, I've definitely stretched it.
That's all right.
Stretched that metaphor too far.
That's all right. A question's come in, actually. Thank you, Paul. Does deflation lead to default?
Yes.
Simple answer.
It's a short answer. The longer answer is, will central banks and governments, how much are they going to try and protect people from default?
That was my next question. Yep.
Yeah. So
the other thing is, what we're talking about here is probably a 12 to 18 month cycle. as this comes off, and we expect commodity prices to bust into this as well, with China leading the tightening on monetary and fiscal policy. But then you look beyond that, and as I was talking about before, once you get past the air pocket in fiscal demand in the US and you get into later 2022 and 2023, there's a lot more fiscal coming, a lot more stimulus coming. And so, this is a sort of boom bust in inflation. And at the end of it, you're still going to be starting a relatively new business cycle with reasonably robust labour markets, and you'll have all of this second wave of supply side stimulus come through. And so it should actually result in higher inflation versus the low inflation cycle that we've just experienced over the whole cycle. But you've got this wild boom and bust come around inventories at the beginning. And then we settle into something that, is a little bit driven by modern monetary theory, MMT, more fiscal than we had in the last cycle. And I think we think that the deflationary forces are still very large structurally. So it'll still be very difficult to produce inflation, but the right approach to it is to spend more fiscally. And that's what the US is planning. And so it at least will have stronger inflation than the last cycle. That is not tearaway inflation, and it's very unlikely to be scary inflation, but more than they had, which is one reason why once we get through all of this stuff, these booms and busts at the beginning, that we're quite bullish on US growth, US inflation, and the US dollar.
Okay.
But and in the interim though as well, like a lot, that's the longer term view, that's subject to what we see governments doing. So if you all of a sudden had a big pushback to the Republicans, say in the midterms, and Biden loses his majorities, and Republicans have decided that they do want to pull back on spending for either some of them for real purposes because they think this spending is wasted, and other ones for political purposes because they believe that a weaker economy means they've got a better chance of getting their president in. If you see those types of things happening, then a lot of what David's talking about starts to unravel. So a lot of this is very much dependent on
China may turn the spigot back on, at any minute, and commodities get the support that they're about to lack. So obviously it's all very, very policy dependent. Yeah.
Very good. Question I had, and it's sort of just borrowing off probably the other side of Paul's question there, and does deflation lead to default? The question for me is, does inflation lead to default? And where I'm going with this is obviously, central bank responses to, their two general drivers, which is, controlling unemployment and keeping, tabs on inflation. How long would a sustained inflation bubble, say, if this pig in the pipe comes true, would need to be sustained, or do you think that they're capable of seeing through it as well before they start deciding they're going to need to tighten?
I think there's two things on that front. The first one is the risk that they fall for the inflation panic, and so you get a policy error. I mean, it doesn't look like they're going to do that in the US or here, but it's always a risk. And then long term, well, absolutely. I mean, Goldman was out today with a reasonable note, I think, from Jan Hatzius saying, the drive for inflation, the fiscal drive for inflation and monetary in the US, may succeed, in which case they'll actually have to hike rates more later because they've done fewer earlier.
Yep.
And so if they do embed inflation and inflation expectations, and they get some decent wage rises, say 3.5% or so, or maybe even 4%, then, and I'm talking about a labour market down at 3% unemployment, quite tight, then they, we will see some rate rises, and yes, you're going to get some default come out. But I think that's,
but yeah, that's
large. I think that's a circumstance that's contained to the US. And this comes back to the way we see the US leading the cycle and China lagging it. And so if the US is out front with all this fiscal spending and delivering more inflation, and I'm not saying they're going to have to hike rates to the moon at all, but if they have to hike them a little more than they did the last cycle, in a few years' time when their labour market's really tight, then the US dollar runs, and so you've got China structurally slowing and dragging down commodity prices. You've got a strong US dollar dragging down commodity prices, and that whole arrangement of a strong US and a softening China is really deflationary for the world. And so you'll start to see Europe really struggling, emerging markets will really struggle behind China, and that becomes really deflationary. And eventually that feeds back into the US. So it caps how far its inflation can get. And you've got policy inputs all the way along here as well. But if that's the basic structure of the cycle, and it does look like it will be, with the Biden stimulus very likely to get passed via budget reconciliation, then that's how it plays out.
But answering your question though, Tim, in a short way, is that extra inflation is particularly in wages is actually good. That'll prevent defaults more than it'll create defaults. What David's saying is that might create the conditions that later on make the defaults worse in the future. But in the short term, no, that's what the governments absolutely want. High-ish inflation and low interest rates, so they can start paying down their own debt burdens and let consumers pay down their debt burdens, and companies. Right. It's basically this same setup as what we saw following most of the world war, most sort of big wars. Is that in particular World War II, is that they want to keep rates quite low, allow some inflation to help deflate the size of the debts, and then and then off you go back to a more normal cycle.
Okay, very good. Thanks, gents. Just had one from Jeffrey O'Neill as well. Thanks, Jeffrey. Will food and natural resource inflation be longer lasting, e.g. lumber in short supply, beef prices are so high, suppliers are reducing herds, reduce future supply, labour issues for fruit and vegetables? So more of the soft stuff.
Yeah. Okay, so vegetables, I think we're seeing deflation in. Generally, the price has been quite weak there. Fruit prices, there's been a fair few hikes in prices. Now, the question with those is, are those are the shortages in terms of labour, is that a permanent feature, or is that something that will be solved? And so, if it's a permanent feature, then yeah, it'll be higher. But I don't think it is a permanent feature. I think it is a very short term. And I think for the most part now that we know a lot more about coronavirus, the outdoors there's a very low risk of transmission outdoors, and so I think you'll find fruit picking is it's probably more movement. Well, I don't know about the next hot job, but yeah, there's certainly more. Once you get some more movement, I suppose it's getting movement in terms of people from poorer countries to richer countries. I suppose that's probably a key one there. So you could see a little bit there. The lumber is very much a building factor, and so and a lot of that's this switch between building apartments to building houses, and so lumber prices, they're certainly very high. They're at a level now where it is incredibly profitable to go out and plant more, but obviously it takes a while to grow, and so that is one area where there probably will be a lag, but you're really dependent upon the building cycle as well continuing, which it probably will. But there are some things that sort of, like with rising interest rates in the US, maybe that puts a bit of a damper on it. It does seem to have put a bit of damper recently, but as a general rule, I'd say it'll probably be strong. But will prices be as high as what they are now? That's the next question. Or will you start seeing people say, well,
lumber prices have already started to come off, which doesn't mean they won't go back up again. But
here in the States, the lumber prices are the highest, one of the highest they've ever been. Sort of.
Yeah, they are. They're extreme. But they are. A lot of that housing construction is front end loaded, so we've already seen pretty reasonable falls from the volumes that we had during Home Builder here. I mean, we've still got a very strong housing cycle, so it's not going to collapse, but it's definitely going to come off from the very high levels that we've had. And I'd say that's likely worldwide.
But it is that point that there are some things, and lumber is a good example of one where suppliers will absolutely produce lumber at costs from last year. Like they're happy to do it, but they'll and now that they're double, they're as many people are that can get out and plant and try and push it through. But that's going to just take time. Beef's another one that will take more time. Obviously, a cow takes longer to grow. So as I said, you might be cutting down your herds, but you're doing everything you can to inseminate as many as you can and grow those herds back. But that again will take time. Other food items tend to be a lot faster in terms of the cycles we've seen in the past. Is that if you're talking about growing wheat or you're growing barley or corn or whatever it is, if the prices are high, they start using land that they wouldn't have otherwise used, and there's things that they start converting other fields into crops to do that, and the fields that might not actually be very good at growing those, but it's better than nothing, so they'll get, and the prices are so high they've got to make it. So agricultural demand tends to be pretty quick. And as well you have different growing seasons. Like in Brazil, in certain places in Brazil, they've got like 3 or 4 growing seasons a year. So it's a matter of saying. I have no doubt at all in terms of the food side, especially as population growth has actually sort of shrunk a bit worldwide, is that on the food side, we'll get back to the old prices because that happens so quickly. But there will be elements like beef or lumber that just take a number of years before you get back. But by the time it does, chances are, out there right now, there's probably people planting forests more than what we're going to need. And so in 3 years' time or 4 years' time, as some of that wood is maybe longer, as starts to mature enough to start getting picked, there'll be a big glut at some point going forward.
Okay, fair enough. It just makes me think of that chart I saw this week where matching off avocados to Bitcoin, and avocados won so far from the past couple of years. But anyway, just before we wrap up, actually, here we go. We've got a question come in. From Candy Flip. So if you had to summarize your view on inflation in the last 2 weeks into 50 words or less. Oh, wow. There we go.
Into a tweet length. A tweet length. Is it?
Yeah, I can do it. In the US, it's boom, bust, grind. Hi. How many words is that?
It's probably got a few spare, but anyway, that's all right.
Boom, bust, grind. In Australia, I'd say it's more rebound, grind, lower. Whereas in the US, it's boom, bust, grind, higher. Okay. Very good. Thanks for that. But that will hang in Australia. It will hang on. Ultimately, it will hang on whether they're going to restore immigration or not, which is immensely deflationary.
Yep. All right, very good. And just finally, so what have we got to look forward to next week, guys? So we're going to convert all of this into practical.
What do you do about it?
Yeah, portfolio pieces. So
yep, absolutely. So so you've got your portfolio. What do you do about all these changes? How do you approach it? And keep in mind as well, like a lot of the things we've been talking about have a number of elements of it's not going to. You can't be certain right now exactly how government's going to react, how long some of these supply chain issues are going to take to fade, the whole bunch of other issues, is that you sort of need to go, okay, well, if I knew with absolute certainty that this was all going to happen, then here's where the portfolio would be. And then how certain are you and how are we moving to that point over time as certainty grows?
Okay, very good. All right, gents. Well, that's just about time for today. So thanks very much for part 2 on the inflation special. We're looking forward to next week. We'll jump across to our viewers' question of the week as well. So the question of the week this week is this a typical inventory cycle or indeed something different as we feel as well? So always great to see your comments and feedback in the chat for us to read as well. So looking forward to those. So we'll wrap it up. Thanks again to all of those who've watched in live for another great episode. and to those people who have asked some questions as well. I hope you've taken away some great ideas. And if you haven't already, please feel free to click like on the video now to give us some feedback. If you'd like to see more of our content, head on over to nucleuswealth.com/content to stay up to date on news from us. Follow us on social media, of course. And finally, if you know anyone who gets something out of today's episode, let them know about it, share with a friend, and help our show grow. So thanks again for tuning in from myself, Tim Fuller, and the team. And we look forward to catching you with the next one. Cheers.